Hello, hello.
Hi, Vijay.
Hey,
Thank you. So nice to see you again. Thank you for coming in tonight.
no worries. Happy to be here. I mean, virtually.
Yeah, look, I think we're gonna wait another 5 minutes, and maybe we're gonna start at 7:03,
Okay,
something like
sounds
that.
good.
Okay,
Yeah.
so we'll just give people time to come in. Okay,
Okay.
I'm
All
gonna
right, sounds
I'm gonna
good.
mute myself until then.
Okay, I'll do the same.
Thanks. Thanks everyone for joining. We're gonna wait another 2 minutes before we start. Thank you for your patience and for being on time. Just a couple of minutes more. Okay, I think we can start. Good evening, everyone. Thank you for joining tonight. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway, and tonight I'm joined by Yuejue. Sorry, I'm terrible with pronouncing your name. I'll try again. I'm joined by Yuejue Jin from JP Morgan. Maybe if you want to introduce you very briefly, and then we'll move on, and obviously have a lot of time later.
Okay, thank you very much, and thank you to everybody joining us tonight for us to really share some of our thoughts on fixed income investment. We actually prepare a few slides to kind of walk through a couple of kind of main questions around how we should think about bond investing at this particular timing. So over the next, I think, 15 to 20 minutes, I'll be walking through essentially four main questions. What the first one is, what kind of macro backdrop are we currently living in? And then we'll talk about what are the implications for bonds, and then following on that, we'll talk about what does that mean for investors, especially over longer term. But lastly, how we should approach kind of fixed income investing.
Fantastic, and I'm super looking forward to hearing kind of your presentation. And to be fair, I heard parts of it before when we did it in person around a month ago. Before we go into all of this detail, and I leave you the floor, I wanted to do a couple of things. First, I will do a very brief introduction on StashAway for people attending. Then I also want to set the stage and talk a little about the very basics of bond investing that hopefully will help people understand better some of the concepts you're going to talk about later. And then after you speak, I also briefly speak about our income portfolio that we launched actually in collaboration with JP Morgan, obviously. Okay. So again, thanks everyone for joining tonight. Let me maybe spend a minute or two on StashAway for those of you that might not be familiar with the firm. We are a Singapore headquartered digital wealth management platform. We're live in 5 markets: Singapore, Malaysia, Thailand, Hong Kong, and the UAE, Dubai. In each of these 5 markets, we're regulated as a fund manager. In Singapore by the MAS, in Malaysia by the Securities Commission, and so on and so forth. We work with some of of the largest custodians available. So with Citi, with HSBC, with DPS, obviously with JP Morgan for what concerns this particular income product, and we are backed by blue chip investors including Sequoia, Fidelity, Hamilton Lane, and a few more. I'm not going to go through the various accolades you might have read in the papers around us, but we've been around at this point for more than 7 years in Singapore. We launched in July 2017 in Singapore. We have a fairly broad offer for our clients, and you can see on this current slide, kind of how to diversify further from cash offering to core portfolios, thematics, as well as alternatives. I'm not going to go into the details of this today, because tonight we're focusing on income investing, which is part of our core portfolio. So it should be part of everybody's kind of a core kind of a perspective on how to manage your most of your money. Now, maybe one thing I want to mention is that over the last couple of years, there's been a lot of people that have overinvested and put a lot of their assets into what we call cash here. We actually have a rich offer here, and we have a lot of people. We've seen a lot of success in these products over the last couple of years because of what's happening to interest rates. I think tonight's webinar come at an important time to understand, how you want to play the next 18 to 24 months with what is maybe kind of not super long-term investment. So this is not cash you want to put in your equities portfolios because it's not your retirement fund, but also this is not even your emergency fund. And so, somewhere in the middle, you have been probably getting some good yield from cash over the last year and a half. Things will change in the next year and a half or two. So actually, I think this is an interesting topic to talk about tonight. As mentioned, we also offer alternatives for accredited investors, thematic exposure, and more. If you have any questions on any of this, feel free to reach out to any of our team, or use the Q&A function on Zoom, where some of my team members will actually be happy to answer your questions. So, as I mentioned, I was trying to be very brief on the introduction to StashAway. I have 3 slides on the basics of bond investing, just trying to lay the foundations of some of the conversation. Yuejue will go into much more detail and maybe a bit more complexity. So I'll try to kind of set the base for those of you that might not be expert bond investors. So first of all, why are we speaking about income investing or fixed income investing and bonds today? Things have changed. If you look back 6, 7, 8 months, at the end of 2023, there were high interest rates, and there was the expectation of those interest rates to persist. And inflation, the main risk was sticky inflation. Today, things have changed, and if you read the papers, you will know that inflation has been softening. Growth is still solid, but some of the risks are now starting to be on the growth side more than on inflation side, and there is clear expectations of rate cuts that start soon. In particular, next week, actually, the Fed is at this point expected to do the first cut. The question is not anymore whether they're going to cut or not, but the question is how much they're going to cut, 25 or 50 bips. And this means that there is a very high likelihood we are at peak rates today. And that's why this conversation about fixed income investing and bond investing is extremely timely today. Okay. Now, how does a bond generate returns? You invest a principal, let's call it $100. And if you buy in one single bond, I'm not talking about a portfolio here. If you buy one single bond, you expect a coupon to be paid to you, maybe 5% per annum, so $5 per annum. And then over time, there could be a price movement. It can be positive or negative. In this particular case I showed you in the slide, I'm actually showing a positive price movement. This can be triggered by several factors. It can be triggered by interest rates moving. It can be triggered by a specific situation with the bond issuer. Obviously, if the bond issuer defaults, then actually you're going to have negative price movements. It can be as high as 100% of principal. So there are many reasons that can influence price movements, and that add to your total value. If you hold to maturity and nothing happens, so the issuer doesn't default, your price movement should be zero. So you should actually get your principal plus coupon in a normally structured bond. Okay, so this is how it's composed. Now, the price movements for bonds that are traded actually move with interest rates. So interest rate, as I mentioned earlier, is one of the factors that might move your bond price up and down on a daily basis. And the counterintuitive fact is that when interest rate goes higher, your bond value, your bond price will go lower. And when interest rate go lower, your bond price will go higher. So bond prices move in the opposite direction of interest rates, okay? And maybe the easiest way to understand this and make it a bit less counterintuitive is that if you have a bond that gives you 5% in the next 2 years, and then 6 months from now, average interest rate go down to 4% for that type of risk, you can get a new bond that will give you 4%. And so because now new bonds will actually give you a lower amount, your old bond is valued more, because in practice, there should be kind of a interest rate parity in a way between the old bond that will keep giving you 5%, and so people will be willing to pay you a premium because they only want 4% at this point in time. And that's why when interest rates are going one direction, bond prices go in the opposite direction. I hope I did a decent job at demystifying this very, very crucial topic. Okay. Now, given that today we are in the cusp of probably, and I'm saying that we are about to see interest rate being cut because this is the expectation. Of course, I don't know what's going to happen in the next 2 years. Now, the market expects interest rate to go down, but obviously nobody knows for sure. I don't know for sure. But let's assume for a second that that market expectation proves right. So what you see on this slide is 3 lines. The green line is what happens if you invest $10,000 in cash. It can be, in a StashAway Simple, for instance, if you use StashAway, or it can be in a saving account that yields kind of yields good interest rates. So the assumption here is that right now you get 4%, and then in a year from now you're going to get 3%, and then a year later 2%, and it is steady at 2%. And as you can see, the green line kind of starts higher and then plateaus over time as interest rates go down, because in practice your cash portfolios, as soon as the interest rate go down to 3%, they will actually start yielding 3%. The light blue line and the dark blue line are looking at the bond. And so the light blue line assumes that you invest in a bond that gives you a 4% coupon, and then you keep it until maturity, okay? And so in practice, what happens is that you keep getting your $400 a year, 4% of $10,000. Even when interest rates go down, the coupon will keep being $400. So that's a linear return. And obviously, as you can see, while right now you will actually make the same amount of money as your cash, over time, it will give you more, because when the cash returns start to decline, your bond returns will remain 4%. The blue line is the same bond, but looking at mark to market. So looking at including their value on a daily basis, assuming you might consider selling throughout these 4 years. So you might not want to wait the 4 years. And as you can see, there is a little bit of a front loading of the returns, because price movements will be positive for you as interest rates go down. The coupon will continue to be 4% until you hold to maturity, but there's going to be a little bit of a front loading. Obviously, if you hold to maturity, you're going to get the exact same amount that I mentioned earlier in the light blue line. Okay, so maybe to summarize, what I wrote on the right side is a bond continues to pay the same coupon until it matures. Again, assuming, I'm simplifying, this is assuming a very simple bond. Market price of bonds will increase as interest rate drops, and so total returns will be a bit front-loaded. And lastly, cash rate will decline in line with interest rate quite quickly. Hopefully, I kind of explain a couple of core basic points of bond investing. Usually, I'll let you take it off from here. I'll be your clicker, so just let me know when you want me to move from one slide to the another.
All right, thank you very much. That was actually a very good introduction on some of the very key concepts around bond investing. And I think for our audience tonight, you probably kind of hear, some of the words being repeated a couple of times, like interest rate environment. That's because bond investing ultimately is about, what the macro environment is. Macro environment being where the interest rates, policy is, but also in terms of where the inflation is, where the global economic growth are. And then that's why when we talk about bond investing, I think it's very important maybe to start, take one step back to look at, where we are in terms of the current macro environment, and then to think about what the implications are, to bond investing. So with that, let's maybe turn to the first slide. Just let us take a look at the global growth environment that we currently are in. So the chart here that what we're showing is essentially a consolidated global PMI index, i.e. the Purchasing Manager Index around the world. And you'll see from the top, third to the bottom, we have the global PMI, but also breaking down into different countries. And I think this is a fairly kind of visually easy chart to look at, because as you can see from 2020, that's when, COVID essentially, hit the entire world, where we had a period where PMI around the world was red, meaning that global economic activity was very much in a contraction period. But gradually, we are gradually actually coming out of that period. So towards the more recent times around the world, we see the numbers becoming greener and greener, meaning that economic activity around the world is really gradually picking up. And if you look at the detailed numbers, anything above 50 means that the economy is actually in an expansionary environment. So I think the key takeaway from this chart is that the growth is still benign around the world, and you have DM countries, US and UK, Japan are really leading the way in terms of maintaining a fairly healthy economic growth. But related to that is the next slide. Right? I think all of us probably see this in, media headline a lot, because one of the key macro topic that everyone is talking about is inflation. So if we turn to the next slide, what we have on this slide is another, I guess, a heat map. But this time we're showing inflation heat map. And similar to the previous slide, red is bad, which means it's very hot, although, in terms of temperature, it's actually on the other country. So red is actually hot, meaning the inflation is high. But if you can look at, across the, around the world, gradually we are also, moving into a period where, inflation around the world is cooling down. If you look at, individual countries, right, and when we look at US, I think the July, inflation number coming out being pretty much around the expectation, around 2.9%, which is still above the Fed target around 2%. So there's still a bit of work that central banks need to do. But if we compare to where we were, 2022, we are in a lot benign environment. And I think everybody is laser focusing on, the CPI report that will be coming out from US later this week, which will be a very good indication to probably guide us in terms of where the Fed will be moved and how much they will be moved next week. But I think a key takeaway from here is, inflation is cooling gradually. And for Fed, this is essentially creating an environment where they can start to think about easing policy gradually. So when we put these two together, growth is benign, still solid, still healthy, inflation is cooling down. So what does that mean for central banks around the world? Now, what we have on the next slide is to show, what we think will happen from a, policy rate perspective. And I think US is probably the focus, and which is, everybody will kind of watch how Fed will navigate this period next week. But our view is, Fed clearly will start easing next week. It's a debate right now still within the market whether they will start with a 25 basis point cut or a 50 basis point. And I think market is pretty split, right? Before the labor market data coming out last week, I think the market consensus was more to around 50 basis points. But right now, I think the majority of the markets are more towards maybe 25 basis points, given, the data coming out last week was a little bit mixed. Our base case scenario, though, is that we do think the Fed will start easing next week, but the first cut will be around 25 basis points because of a number of reasons. Obviously, this is a big election year for US, so they want to make sure that there's no clear, finger pointing in terms of policy mistake. So they are very likely want to start with a relatively mild pace. And also from a communication perspective, it's a lot easier, to anchor something small, but gradually look at upcoming data, then decide where the pace are. But obviously, the other reason is if you look at US consumer, if you look at job market, I think all of these data are very much pointing to a 25 basis points next week. But beyond next week, we also think that, Fed is in an easing phase. We will be looking at potentially, 2 to 3 cuts in total this year, maybe another 2 to 3 cuts next year. But I think what's more important is on the right-hand side chart, where you can look at, all the other major central banks around the world. Except for BOJ, I think pretty much, all the major central banks are very much in the same pace now, right? Some of those central banks have already started the rate cut, but everybody around the world, is essentially into a easing. And this is essentially a new start of a easing cycle that we're looking at. So, coming back to bond investing, right? We talk about growth, we talk about inflation cooling down, and we talk about, central banks around the world starting to ease. But what does that exactly mean for bond investing? If you turn to the next slide, what we're showing here is really a relationship between the interest rate environment and how bond returns will behave. And I think, in the intro, and then we already listened to some of the basic kind of relationship. And I think the key is to remember there is always an inverse relationship between the interest rate environment and the bond kind of total return. So what we kind of illustrate on the right-hand side chart is to show how bond return will be like if there is 1% interest rate movement. Right? The gray bars indicate, when there is a 1% interest rate cut, what's going to happen to different bonds performance. But the blue is when there is a 1% interest rate increase, what's going to happen to different bonds. And as you can see, across the board, all these different kinds of bonds would generate a positive return when the interest rates are coming down. And I think, we have already listened to the reason behind, because when, you're getting interest rate coming down, the bonds that are generating, the income as it is will become a lot more attractive, and hence, people are willing to pay a premium to buy the same bonds, and hence the return will become positive. But if you look at the left-hand side chart, I think that's even more kind of direct to showcase, how bond will perform when the interest rates or when global central banks or US Fed entering a easing cycle. If you look at the chart here, the different lines actually represent different historical periods. And if you look at in the middle, you see all these lines are crossing. We're actually missing a line here, but that's essentially, everything that's crossing the exit is where, Fed finished the last hike. And all the other lines across different historical periods, US Treasury, in the following 12 to 24 months are actually generating fairly positive returns 100% of the time. So again, illustrating that when we're entering a easing policy cycle, that's when bonds are actually becoming quite interesting. But what about valuation, right? When we talk about equity investing, one of the topics that comes up a lot is valuation for equity is actually quite stretched. So the question is, what about the valuation for bonds at this moment? If we turn to the next slide, what we're showing here is the valuation across different bond segments. Now, when we look at bond valuation, we don't look at PE ratio or PB ratio, and instead we look at yield. Yield is a very good indication of how cheap or how expensive bonds are. And again, here the relationship is an inverse relationship. So i.e., the higher the yields are, the cheaper the valuations are. Again, using just a cash flow discount kind of methodology, you can think that if you're generating a lot of yield, meaning that your current value of the bond is actually cheaper. So that's why there is an inverse relationship here. What we are showing here is the current yield, which is the blue diamond, in each of these gray bars. Each of the gray bars represents a type of bond, and the blue diamond is where the current yields are. And as you can see, it is actually in the higher half or higher end of the historical range, which is the gray bar. And if you compare that with the purple line, which is the 10-year median, again, across the board, bonds are not only not expensive, but they're actually on a relatively more attractively priced kind of level. And I think similar, I would say, attractiveness would apply if we compare, bonds versus equity using a standardization, which would also show you a similar picture where bonds are actually relatively more attractively valued. Now, if we turn to the next slide, so we talk about, bonds entering an interesting period where it actually potentially can generate some positive returns, and we talk about the current valuation is actually still quite attractive. But when we put everything into a portfolio concept, right? When we look at bonds roles in the investors overall portfolio, what exactly are the roles for bonds? What we're illustrating here is a longer-term return assumption or return expectation for bond. We all, often talk about equities are those more kind of sexy investment, and the bonds are boring because bonds are just income and they don't really move around that much. But actually, if you look at over longer term time horizon and annualize them and look at their average annualized return, some of these bonds or types of bonds are actually generating fairly decent return. right? As you can see here, IG corporate bonds or US high yield, their returns are actually not small. And if you think about the potential volatility that are associated with these bonds, from a risk-adjusted perspective, these are actually pretty attractive over longer term. But what's more important is, when we look at, the different investment options that you currently have, when we turn the slide to the next one, we often think of bonds as, one step up from your cash investing, from your cash deposits, right? I think over the past few years, we all know that cash are giving actually pretty nice, well, actually very nice, deposit rate. So that's why a lot of investors are pulling their cash into, time deposits. But things are going to change very soon, with central banks around the world starting to cut yield, cut interest rates. The interest rates that you're able to yield from your cash deposit will become, essentially a lot less attractive. And what we're illustrating here is to show, in the different periods when, Fed is raising interest rates versus when the Fed is cutting, which is illustrated by this black line, what is the relative return between bonds, shorter duration bonds versus cash. So we have gone through a period, which is, the yellow orange-ish bar on the right-hand side, where we have gone through a period where, Fed is increasing the interest rate, and hence, the cash is actually generating, nice kind of return. And that's why the relative return between bonds versus cash is actually has been, less attractive or negative over the past kind of 2022, 2023. But we're entering a period where, Fed is starting to cut the rate. And history has shown us that during Fed's cutting rate, during periods where Fed cutting rate, bonds is going to generate a lot more attractive return for investors, because cash yield is coming down, where bond price is potentially, going up, in addition to the bond coupon that you're already collecting. But what's more important, again, is the next slide, which is when you put these into your overall portfolio, what bonds can really do for you is to provide that diversification benefit. Because a lot of us, I think, including myself, actually invest quite a bit in equities, right? And what we're showing here is, the return variation for different type of asset classes. And we all know equity is high return but high risk. And the deviation or the variation that you could get from equity, can actually deviate quite a bit, which is the green bar here. Bond obviously will provide you a smaller return, but with less volatility, which is the blue bar here. But what's more interesting is when you combine bond into your equity portfolio, this negative correlation between bond and equity can really enhance your overall risk-adjusted return for your overall portfolio. And then that's ultimately, is a very, important rationale for investors to consider in the bonds. And we have already started to see that benefit over the, the recent few weeks. Right? If you look at, I guess, the last week of August, when S&P was down by more than 5%, bonds was actually generating some positive return. And similarly, last week, when US equity was down again, bond again, demonstrated some negative correlation, which ultimately would provide this diversification benefit. So we talk about all these kind of why bonds and why now, but then the question is, how should we approach bond investing? Should we just go and pick individual bonds ourselves? Actually, bond investing is not as straightforward. And we actually have a couple of slides to illustrate that. If we turn to the next slide, one of the kind of challenges when it comes to, bond investing is there are actually many different types of bonds. Right? There's IG corporate, there's government bond, there's emerging market debt, there's US Treasury, there's US high yield. And at each different year or, at the different time of the market, each of these buckets could perform quite differently. And the winner of this year may become the bottom of the list next year. So which bond segments should we pick, or what asset classes, sub-asset class should we allocate to within bonds? That's the first question, or that's the first challenge that individual investor would be facing. Once you decide which segment you want to allocate, then the next question is, so which bonds should I buy? So is it easy just to kind of randomly select a few bonds? And the answer is, again, it's not as straightforward. So if we turn to the next slide, what you can see here is, these are actually professionally managed funds across different asset classes, and we rank them by, the top performing equity funds versus the bottom performing equity funds. And on the right-hand side, you'll see, the difference between the top performing fixed income funds versus, the lower ranking fixed income funds. And again, even among the professionals, right, when those are professional portfolio managers, and when they go out to select bonds, there is a big difference in terms of the alpha or the outcome they can achieve. And over years, this difference can actually accumulate and become quite a big. So selecting individual bonds is actually not that easy. It's actually a fairly difficult or fairly demanding job, because you need to know which credit you want to go into, whether there is any default risk, and how you control the overall risk, and what duration you want to have. There are all these different questions that you need to answer to pick the right bond, but also construct the right portfolio. And the other potential challenge for bond investing is the FX component. If we turn to the next slide, what we're showing here is the US dollar FX rate versus Singapore dollar over the longer history on the right-hand side. Obviously, FX over longer term will have different changes, which means that if you're going, abroad and buying a bonds that are not denominated in your home currency, depending on where that currency, that foreign currency moves, that could potentially affect your return if you're not hedging that currency exposure. But what's more important is we want to buy bonds because of this lower volatility profile, because of the stability that it adds to your overall portfolio. But having FX, if you look at the shorter term period, and if we zoom in, have the ability to zoom into the slide, FX market is a lot more volatile than bonds. So if you do not hedge FX, and what means that FX volatility could becoming a driving force and really increase your volatility, for your bond investing from your home currency perspective. That's why our recommendation, and we think that is probably the more prudent way for investors to think about overseas bond investing, is to hedge the currency, so that you remove that uncertainty, you remove that volatility, and you can get a more pure and more stable bond returns. Now, hedging obviously comes with the costs, but if we look at the potential bond opportunities around the world, even by considering and factoring the hedging costs, we still think that's still providing a fairly attractive opportunity versus the opportunities that are available in the domestic market. And if we move on to the next slide, so we talked about the challenges. Then the question is, or the answer to those questions is, how do we approach bond investing? So on this slide, we just list out, a number of kind of, considerations or matrix that we monitor, we analyze on a day-to-day basis when we decide where we want to allocate within the fixed income world, when we want to decide, which bonds we want to buy, how much we want to buy, how we want to construct a portfolio. So these are just a number of examples that we want to showcase here to show you that there are actually a lot of homework that we do, and it's not an individual homework, it's all team-based and a global process, and it's a big team working behind the scene, making sure that we construct the right portfolio. It's well-balanced, it's well-diversified, and it has the right exposure to get the right opportunity. So putting everything into kind of one slide, that will be the next slide. So this is just an illustration of, the income portfolio that we put together. We advise StashAway. And I think, the key here is really, if you look at the left-hand side, we want to make sure that this portfolio is well diversified so that it captures different pockets of opportunity, but it's not exposing to any individual risk to a high degree. But what's more important, we want to make sure this is a high quality portfolio. That's why the average credit rating for the portfolio is investment grade, and we make sure that it's meeting that requirement. And in Singapore dollar, even after factoring the hedging component, we are still yielding fairly nicely at 4.5%, and with a moderate level of volatility. And we're hoping that through this professionally managed portfolio, we can provide our investor with some decent, income opportunity, but also help provide that diversification and, stability to their overall portfolio. So with that, I guess these are the slides I wanna share. I'll just pause here, to pass them back.
Thank you very much. This was very informative and very interesting. Hopefully it was interesting for most people on the call as well. Just a reminder for everyone that we have a Q&A function in Zoom. If you don't see it on your screen, you might click on more, and you should be able to find it there. I will go through all of the questions that we receive in a second. But before we do that, I just want to double click on, in practice, this slide and look at what we did, what we launched, what we call the income portfolio, together with JP Morgan, as Yuejue mentioned a second ago. So the idea behind the StashAway income investing portfolio is to make it easy to earn stable income. And so we're working with JP Morgan to provide a Singapore dollars denominated fixed income portfolio where the asset allocation among those fixed income assets is actually managed by JP Morgan, with the goal of providing attractive yields and flexible payout with a risk managed approach. So by thinking at risk the whole time. Now, the flexible payout is actually a feature that we layer on top through the StashAway app. In practice, you can decide how much you want to withdraw from that portfolio and how frequently. Obviously, you can also decide to reinvest everything, but you can do it it's very flexible. You can do it on a monthly basis. You can change your mind every month or if you want to, with no cost. So there is no cost to the withdrawal. There's no cost to the changes. As usual, in StashAway style, is quite flexible without any additional costs. Now, let me talk briefly about some of the features, and then maybe I'll go into the numbers in a second. So first of all, the yield to maturity after fees is after the fees from JP Morgan is 4.3%. So the slide I was shown earlier was before fees. That's the delta, the 50 bips between 4.8 and 4.3. And I'll show you the waterfall of where this comes from in a second. If you saw from other providers or other banks, somebody telling you 6.4%, 6.5%, that number is in US dollars. So I'll show you the waterfall in a second. So you need to remember to compare apples and apples. As mentioned by Yuejue, it's very, very difficult to pick bonds and manage bond portfolios. So this is professionally managed. That's what we partner with JP Morgan Asset Management, which is one of the largest and definitely most revered bond houses in the world. Simple and flexible, as we always do for each of our products. As you probably heard me saying before, we always want to make it simple and cost effective to invest intelligently. The income investing portfolio is not different from this perspective, and you can invest in it through your cash investment as well as through your SRS if you want to. Now let's look at the portfolio composition and numbers for a second. On the left side, you see how the portfolio is currently composed from a funds perspective. So there is 29.5% in the JP Morgan Income Fund, which is a diversified fixed income. There is another 29.5% in the JP Morgan Global Bond Fund, which is also diversified. There is 11% in a high yield bond fund, 15% in a US aggregate bond fund, and 15% in emerging market debt fund. What you see on the right side is, first of all, the portfolio yield to maturity as of now. And this is, as I mentioned, is net of fees. I'll show you the waterfall in a second. We also showed here, the performance since inception, which has been 1.8% between the 16th of July when we launched to the end of August. You might do the math and say, hey, 1.8% in 1.5 months is way more than 4.3%. And this is true. It's in fact 4.14% annualized. Why is that? Because of what I said earlier. When interest rate go down, your price of the bonds will go up, and so you will have kind of a immediate higher return. So that's why investing in bonds at the peak of interest rate environment is actually probably a good time to do it. And again, I don't want to encourage people to time the market, but these are obviously, you need to know what's happening in the market to make those decisions. Portfolio duration, as mentioned earlier, is 4 years, and expected volatility 3 to 7 years. And I'll ask you a question on portfolio duration in a second, Yuejue. Okay. Now, I promised to show you the waterfall. So, as mentioned, the yield to maturity that I talked about a second ago is 4.3%. But let's start from the beginning. So, in US dollars, the current yield to maturity of the portfolio is actually 6.7%. Unfortunately, hedging costs are quite expensive right now. So if you don't want to have US dollar volatility, which, as mentioned by Yuejue before, is very important if you think in Singapore dollars, that's actually quite expensive. It costs 1.9%. So it brings your yield to maturity in Singapore dollars to 4.8%. To that, you need to take away JP Morgan Asset Management fees, which is 0.98%. JP Morgan Asset Manager actually gives us back half of that, and we give it back to clients. So you, as a client, get back 49 bips out of this fee. So the total actually net fee is 49 bips. So you land with a portfolio yield to maturity net in Singapore dollars or 4.3%. When you compare these products with other products in the market, remember that if you see a number that is significantly higher, this is what you're looking at. You're looking at US dollar yield to maturity. This is not what you need to look at. You need to think about what comes to you. We have always, as you know, transparency is at the core of our values. And so that's why we actually give you the ultimate number you need to think about, rather than a number that actually doesn't really impact you. In the app, if you invest in the product, you see on the left side, you'll actually be able to see returns and weightage by each of the funds that I mentioned earlier. So, and what you see here is a screenshot as of the 6th of September. So a few days more than what I showed you earlier. We just reported on the right side the numbers in bigger fonts, so it's easier to see. This is something you can look at on a daily basis as you kind of check your portfolios. You can also check your current weightage and see exactly how it is. Again, you will see that these numbers are actually higher than the 1.8% that I mentioned a couple of minutes ago, and that's because actually in the early September, again, interest rate went down a little bit, and so there was a little bit of a spike in return. So portfolio return from inception was actually 2.4% as of the 6th of September. Now, I want to leave you with a few questions for you. First is your cash allocation excessive? And what I mean by that is all of us should have some cash allocation. All of us need to have an emergency fund. Many of us over the last year and a half decided to keep a larger share of cash for two reasons. A lot of us thought that there was a lot of uncertainty in the equity markets. When you looked at the bond markets, actually the returns on bond markets were lower than returns on cash because the yield curve was inverted. And therefore, a lot of people kind of decided to keep a larger allocation of cash. I think you need to ask yourself whether you want to keep doing it in the next 6, 12, 18, 24 months, or if this is something that you want to change. Again, I'm not encouraging you to reduce your emergency fund and your cash you need to keep aside. I'm encouraging you to think about your investment pot allocation. How much you want to put in cash, how much you want to put in fixed income and bonds, how much you want to put in equities. So the second question is, do you want to have income generating assets in your portfolio? Because obviously, depending on where you are in life and how you want to invest, you might well decide that you have a small cash holding and then you put everything in kind of equities. But then you want to have bonds exposure for two reasons. One is potentially to kind of reduce your risk and hedge, kind of reduce your overall portfolio risk. As mentioned by Yuejue, you actually will increase your overall risk-adjusted returns. And secondly, to generate income. And this is a question that only you can answer. What is your risk propensity? What are your goals? When do you need this money? What is your timelines? This is an important question you need to ask yourself. Lastly, if you decide to actually have income generating assets, do you want to do it yourself by picking bonds and going to your bank and potentially investing $200,000 in a single bond, because those are usually the ticket size? Or would you rather have a very diversified portfolio that is managed professionally? And obviously, our recommendation is to do the latter, and that's why we actually decided to partner with JP Morgan on this product. I'm actually quite excited about it, and I've been investing in myself. So before we go into Q&A, I'll leave this on the screen. If you kind of use this QR code, you'll actually be able to invest with StashAway with a first $50,000 managed for free for 3 months. Okay. Now, let me go through some of the questions. Actually, before I go through some of the questions that came here, I wanted to ask you a couple of questions on what I just said a couple of seconds ago. One is, what is your expectation on the hedging cost? I mean, it's been very high right now, and obviously it reduces the US dollar to Singapore dollars yield quite significantly, as we just saw. Is this a kind of a specific, like a fact? Is this so high right now because of volatility in the markets and you expect it to go down, or this is a number that will be kind of a very high for a long time?
I think interest rate, okay, so hedging cost ultimately is dependent on the interest rate differences between the two currency or the two countries. So when we look at, where the hedging cost is, it's ultimately, because US is actually in the peak in terms of its interest rate. And as we discussed from a macro environment, US is actually entering, very soon, a easing cycle. Our view is that with the US start to cut the rates, there is a potential that the interest rate differentials or the hedging cost will, potentially come down. But we would say that, there would still be some gap in between. Hence, while there is a narrowing, potential, there would still be some costs, going forward. But I would say 1.92% is probably already at the peak, and directionally speaking, going forward, that cost should come down.
Thank you. Yeah, that's what I wanted to clarify. Thanks a lot. One question that comes from the audience, from actually two people in the audience, is, can you speak a little bit more about what it means that there is a 4 years maturity? And maybe one question for me additionally on this is, do you expect the 4 years maturity to change over the next 1 to 2 years in these portfolios?
Okay, so I actually was also looking at the question. So let me just start by clarifying. When we say 4 year, that is actually duration, not maturity. So there is a slight difference. The number will be similar. So when you have a bond portfolio that has a 4 year duration, the actual average maturity would be similar, but not exactly the same as 4 years. So those two concepts are actually different. Maturity means that, the life of the bonds. So you buy into the bond, but when will the bonds mature? So when will the bonds expire and you get your principal back? So that's what maturity means. And the maturity is essentially just kind of give you a sense of, the structure of the bonds. But duration is a different concept. But because of the maturity of the bonds that actually driving, it's a key, I guess, the driving force behind the duration. That's why those two numbers are actually quite close. But ultimately, duration is a measurement to measure how sensitive the bond price are related to a interest rate movement. So it's a measure of interest rate sensitivity. And the reason these two numbers are quite kind of close to each other is because the longer the maturities are for the bonds, the more sensitive the bonds are, related to the interest rate changes. Because you have 1% change in your interest rates environment, your bond price, because you have a longer, I guess, remaining life of the bonds, that would affect, to a bigger degree in terms of the bond price. So when we look at the duration of 4 years in the bond, we would describe that as a modestly positioned duration, i.e. it's not an extended duration for us, so it's not too long for us. And the reason for that is when we look at where the markets are pricing now, we actually think that while medium term, we think the duration is going to have a very positive outlook, i.e. bond price will be, potentially having, a very strong upside from here going forward. But the path, from here to that will be a bit patchy. And we have already seen, right, over the past a year or two, bond price actually quite volatile. And that's because, people are quite anxious in terms of whether or not Fed will cut, how much it will cut. So that actually drives a lot in terms of the, the volatility. And also inflation number comes out. Sometimes it's slightly above the expectation. Sometimes it's weaker. So there's still a bit of volatility there. So we're not in a hurry to actually extend the duration. We don't want to add too much duration at the moment. We actually think that where the markets are pricing, if you look at where the markets are pricing, the market's actually pricing 8 cuts from now to the end of next year. It's actually quite aggressive. So we want to be a bit patient. We want to start to add duration so that we're moving from the extremely short duration or cash-like bonds so that we can generate a bit of positive returns. But we're not in a hurry to aggressively extend duration. Once Fed starts to actually cut next week, and once the cutting path is more clear, and once the newer incoming inflation number also reconfirming that inflation will continue the downward trend, we will start to gradually add duration. But again, because the whole portfolio is meant to provide that stable income, to have that moderate volatility as the profile, we want to keep any position to be more modest so that we're not exposing to too much of a risk.
And at peak, a portfolio like this, how much duration would it have? Like, if in a couple of years, what do you expect it to be?
Yeah. I think we would potentially expect this portfolio to, add to maybe 5 years or 6 years, but you're not going to see this portfolio to be, say, 10-year or over 10-year duration to that extreme level.
Makes sense. Perfect. Maybe a question on the portfolio composition. There is Anthony asking, is it risky to have more high yield, 31%, than investment grade at 17%? How do you think about that?
So I will probably answer from 2 angles to that question. I think, the first, if we can actually turn back the slide to the diagram to show the portfolio mix. So the way we kind of illustrate, so this is again purely from an illustration perspective, we actually carve out the portfolio to show you different sub-asset classes, and high yield being one hand, you see a fairly, a big number, 31%. But the rest of the portfolio is actually a higher grade mix, right? And we wanted this portfolio to be diversified. That's why, you have actually different color, different buckets in the fixed income so that we capture different parts of the opportunity. But there are 2 very important considerations in this. Number one, we, in terms of our view, we actually think that high yield is still in a relatively healthy environment. And from an investment perspective, we often describe high yield as a no recession asset classes, i.e. if there's no recession, high yield, historically has always delivered positive returns because high yield ultimately is down to, corporate strengths, right? If corporates, are running healthy balance sheets and running strong earnings growth, they are able to continue to serve their debts and, providing you the coupon. So when we look at where the corporate earnings are, where the balance sheets are, they're still fairly healthy. And the default rate at around 1.8% as of the latest is actually a lot lower than historical average. So the starting point is actually quite healthy from a corporate or from a macro environment kind of perspective. But what's more important is actually the kind of the words that we're trying to highlight in the center of the diagram, that while we're getting some exposure into high yield, we make sure the entire portfolio overall is still a high quality portfolio. So that's why, there is a very restrictive guideline requirement actually from our partner StashAway to make sure the average credit rating of the entire portfolio is still investment grade rated, so that while you're getting some exposure, capturing some opportunity, but your overall portfolio is still well controlled at a higher quality level.
Thank you. There is a question on asking, will the published info, so I guess it's portfolio duration, yield to maturity, volatility, be updated frequently in the next 4 years?
We actually provide monthly kind of information for our partner, and I think those are available on the website. Right?
Yeah, no, but I think obviously, sorry, maybe you're right. Maybe you interpreted the question right, and I interpreted differently. So I guess, the short answer to the question is we are super transparent. You're always going to have updates. I guess my question is, how often do you expect these things to change? So you mentioned duration might go up over time, up to 5, 6 years. So, how volatile some of these informations might be over the next few years?
I think there will be changes, because this is actively managed portfolio, both from a top-down asset allocation perspective, but also in terms of the individual bonds of each of the funds that are selecting. So it is actively managed portfolio, and hence you should expect there will be changes. But from our overall kind of philosophy kind of perspective, and also this overall proposition of the portfolio, we want this portfolio to be a core part of your portfolio, and hence it kind of has this stability and a lower volatility kind of profile. So that's why you wouldn't see this portfolio to swing from one end to the other end on the risk spectrum. You will see this portfolio to be relatively more modestly positioned kind of throughout the portfolio life. But there will be changes, say, if we, a couple months down the road, if we see the path is really more established and reconfirmed, we would gradually add in duration, 0.5 year, per month, for example, but you wouldn't see us all of a sudden jump to, 10 plus years from a duration perspective. So I would say it's actively managed, but it's relatively stable.
Perfect. Thank you. So there is a question which I think I will need to take myself, but obviously I'll maybe rephrase this later for you to answer as well. So the question is, we are currently publishing 4% yield with Simple Plus, which is one of our cash management products. And this product, how is different? So what is the difference between one and the other product, other than the different fund managers? So obviously, you're right, different. So whoever asked the question, different fund managers is correct. But more than that, the two products are quite different. So Simple Plus invests in money market funds and ultra short duration bond funds. So for instance, on duration, Simple Plus is currently at around 1 year, or actually slightly less than 1 year, so much less duration than the income portfolio that we've just been speaking about. So in a declining interest rate environment, particularly if the yield curve were to steepen a bit, which I guess what people expect, what means is that interest rate for sure for the short term will be lower than interest rate for the longer term, you will see the delta between the yield to maturity of the income portfolio and the yield to maturity of Simple Plus to widen. So you'll see actually the Simple Plus yield to probably fall a bit faster than the one from the income portfolio. And this is, as I mentioned, just because of where the two portfolios invest from a kind of which part of the yield curve, which part of kind of what average duration the two portfolios have. And also, as mentioned by Yuejue a second ago, the income product that we're talking about today not only has a little bit more average duration, but also invest in pockets of the fixed income market that actually tend to generate higher yield, like for instance, high yield type of products. So those are, I guess, the bigger differences. I think in general, the way I would think about it and the way we present them on the app is that Simple Plus is part of our cash management suite. So to me, it's still cash. Maybe obviously it's cash plus plus really, but it's still a cash management tool, while the income portfolio is more of a kind of income investing or fixed income investing type of tool. I know Yuejue might not be familiar with the Simple Plus as a product, but it's a composition money market fund, an ultra short duration bond fund with maturity of 1 year. Would you want to add something to what I just said, just to clarify maybe?
I think what you just said make perfect sense. I guess the other thing I would add is ultimately, if you compare this proposition versus the money market or ultra short kind of bond type of portfolio, the volatility profile is slightly different, right? So this one would have some volatility. We would consider this as a modest risk kind of portfolio. Hence, it has, I say, a volatility in the range of 3 to 7% over longer term. So it does have volatility. But the contrary to that, or the associate a potential opportunity to that, is you would also have a higher upside, right? That's kind of coming hand in hand. So you have potentially slightly higher volatility, but you would also have higher upside. So that would be the only thing that I would add.
Perfect. One more question on the yield to maturity. Maybe this requires a bit of an explanation. So somebody's asking, what does yield to maturity mean? Does that mean that the coupon earnings are reinvested for the full year? Let me couple it with another question, which is, are the coupons paid out monthly or quarterly? Maybe we want to kind of clarify that. And then so I'll let you clarify, and I'll explain how it works from a StashAway experience perspective.
Okay. So yield to maturity, again, it's not an actual yield, right? So it's not the actual coupon that you're getting. So yield to maturity is essentially, again, a measurement to measure how much total return you would potentially get if you hold the bond based on the current price to maturity, right? So assuming you're buying a bond, say at $9, but the principal, the face value is $10, or vice versa is $8, so but whatever. So there is a bit of difference between your entering price versus if you hold that bond to maturity, the principal you're getting. In addition, the coupon you're collecting along the way. So it's a measurement to indicate the potential total return that you are going to get with the coupon, with the price change, with the principal you're getting. So it's an illustration of how much income you could potentially get, how much total return potential you're getting, but it's also an indication, that's which the concept that we mentioned earlier, the valuation, right? Is it cheap or is it expensive? So that's a common, I guess, concept that we often use. But a large chunk of that, because bond price doesn't move as dramatically as equity price, hence a large chunk of that is a good indication of the actual income level of the bond. That's why, a lot of times we often use yield to maturity as a illustration or indication of the potential income that you're going to generate, you're going to be receiving from the bonds.
Perfect, thank you. And maybe let me add something on this. So if you invest in the StashAway income investing portfolio that invests in these products from JP Morgan, you will invest in accumulating share classes. What that means is that all of the coupons that the bonds are paying to the funds actually get reinvested immediately, right? So you don't get that. Why did we do it this way? Because then we, in reality for you, it doesn't matter whether the returns are coming from coupons or from capital appreciation. If you want to create a stream of income for yourself, you simply need to decide how much to pay yourself. So what the app allows you to do is, and as I mentioned earlier, this is super flexible, no fees charged. You can change it anytime. You can decide how much to pay to yourself on a monthly basis. You can pay $100, $500, $1,000, $2,000, whatever. Obviously, you should not pay yourself more than what the kind of expected yield of the product is. Otherwise, what you're going to see is your capital go down over time. Still a choice you can make, but if you want to make it, this should be an open choice that you're making, not a mistake, right? And the app actually allows you to do this and will actually warn you if you're actually selecting a number that is excessive given the yield profile of the funds you're investing in. And as I mentioned, so these answer some of the questions. So one of the questions was, are the coupons paid out monthly or quarterly? you can decide whether you want any coupon, like, or any, I wouldn't call them coupon, any distribution. You can decide to reinvest completely, or you can decide to receive monthly and whatever sum you decide to receive. Okay. There's one question from Anand on, is it too late to purchase the bond fund when the interest rates start to cut in the next 1 or 2 weeks?
I think we kind of touched on this earlier, that one, from an overall macro environment perspective, we're not talking about just one cut, right? We are entering a period where, central banks around the world will cut a number of times, will continue to cut at least towards the end of next year. So I guess it's a start of a new kind of phase in the cycle. But also, more importantly, if you look at where bond valuations are, it is actually at a relatively more attractive level compared to historical range. So I would say, the opportunity for bonds is not just, for next week or in 2 weeks. It is a medium-term opportunities, and that we think bonds are actually quite attractive at the moment.
Perfect. So Anand also is asking another question, is 4.3% is the yield to maturity, but what is the real return we get per annum? For example, other bond funds are paying 6% per annum and paid out monthly. Why should I buy JP Morgan bond fund? Let me maybe I'll respond this first. So I have a strong suspicion that when you look at 6% per annum, you're looking at US dollars, not at Singapore dollars payouts. As of now, to get 6% payout in Singapore dollars, actually, nothing really comes to mind, but you need to take much, 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 much higher risks than what we have in the current funds. You're not going to be able to get a higher yield to maturity to what we offer at the risk level that we're offering, because you're not going to be able to reduce costs more than we did for you. And you're not going to be able to actually build a kind of a portfolio of this high quality. You're not going to find anything better than this in the market today in Singapore. Again, if you see numbers that are above 6%, those are all US dollars numbers, as I showed you earlier in the waterfall. Maybe let me go back to the waterfall 1 second. Yeah, so we made the obvious decision for me to show you this number. And so on the app, you'll find this number, which is net of everything. Most other platforms, most banks will talk about this number. And this is, I think, wrong. They shouldn't do that, because they are selling you a Singapore dollars return and they talk to you about US dollar return, which is not correct. So we stand by our choices on transparency. Just be careful on how you compare apples and apples. Can we purchase through SRS funds? Yes, you can. So this product is available for SRS as well. How much is the fee of StashAway? It depends on your amount with us. So depending on your total account, not just the income portfolio. So we look at your total account with us, and depending on the size of your account, we charge a certain fee. It goes from 0.8% per annum for portfolios below 25,000 Singapore dollars, and it goes to 0.7, 0.6, 0.5, down to 0.2% above $1 million. So depending on how big is your portfolio, your fees will actually decline over time. So there is an incentive to actually have a larger part of your investment with us. Again, as I mentioned, this will include your core portfolios, your thematics, your income, so that everything counts. Yeah. There's a question on comparing with other provider, but I don't think this is a question that it makes sense to answer. So I'll skip this one. I think we actually went through all of the questions that we received. Maybe I'll wait another 30 seconds. Is there any kind of other thoughts that you want to share, Yuejue, as we wait another 30 seconds, if there is any other question coming up?
I guess I maybe just kind of want to recap, the considerations, right, when you look at bond investing at this moment. Because I think, obviously bond have its longer term role, strategic role in the portfolio for income generation, for diversification benefit. But I think right now is particularly interesting because of where we are in the macro environment. So that's why I think, we know this is kind of cheesy, but stars are aligned for bonds. Whether or not you want to have a medium term or shorter term, I think this is actually quite interesting timing to look at bond investing.
Yeah, no, I agree, and I think the other point that I would make is that as there has been a lot of people investing in cash or holding cash, this is a good time to reconsider that position. Yeah, hopefully there is, there are now better alternatives to cash, I guess, or soon there will be significantly better alternative to cash, and you don't want to be too late in making some of these decisions. I think there is a couple of questions on distribution and payouts. So one question is, can you elaborate on the flexible payout options? So I can choose my own payout amount and the frequency. Yeah, that's correct. You can choose your own payout amount. It can be zero, it can be whatever. And so you can reinvest everything or pay out something, and the frequency. That is correct. You can be monthly, quarterly, yearly. You can decide both of these options, and you can change it anytime. So you can start with quarterly, and then you decide you want it monthly, or start with $500, and then you decide you want $2,000. I mean, obviously, assuming that your portfolio is large enough to support those type of numbers. Yeah. I think we went through everything at this point. So I just want to thank you so much, Yuejue. It's been incredibly insightful and informative. And I hope that, I'm sure that all the people that participated thought the same. Thank you so much also for the time. I know we have been kind of 15 minutes later than I promised. And thanks to everybody that attended the session. Hopefully it was informative. If you have any questions that come up later tonight, feel free to reach out at support@stashaway.sg, and my colleagues will be very happy to address with any question. Also, thanks to my colleagues that have been in the background answering some of the more StashAway related questions, and then also helping with some of the logistics. So thanks everyone. Have a good evening.
Thank you.
Thanks a lot. Bye-bye.